But right now, we think that this spread is about to turn up. In fact, we've had a short-term indicator as of last week that said it is turning now. And we've got certain other levels not far above that tell us we're going to that 2% again. Well, that's a big move. And these spread moves don't occur with silver and gold going down. They occur when they're going up. Okay, silver simply outpaces. So right now, if somebody, asked me what's the best thing to do this year as far as investments, I would be long silver and I'd be long gold and silver miners relative to gold. Gold's the mama. It's going to lead the way up, but it's not going to lead in performance terms. These two subsets of the monetary metal sector will lead. I think it's the best place to be.
Also, like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
When markets go berserk in the latter part of their bull phases, which is quite typical of many markets, they tend to have that acceleration phase. Silver and gold certainly did back in, 1979, 80, then again in 2010, 11. They've been going up for years and suddenly they went vertical quickly. And also at that time, silver tended to sharply outperform gold to the point where you didn't even think it was the same market. It was so vertical. Silver has, I sent you a chart, in fact, a spread relationship with gold that we show going back 50 years, where it shows the peak reading each year, peak monthly close of silver versus gold. So in other words, each year, what was the highest closing ratio of silver to gold? Okay. Now we do it a different way. We divide silver per ounce into an ounce of gold and get it as a percent. Right now we're about 1.13%. Okay. But as you see, going back 50 years, 1974, in fact, that it gets up to 2%, that red line, in 21 of the 50 years. So it's hardly what you'd call abnormal to see silver at 2% of gold. And in fact, during bull trends, for example, back in 1979 and 80, it went up to 6.5% and spent a couple years up there at 4%. Okay. And then in the 2011, 10 and 11 surge, it got over 2%, went up to over 3%. Okay. Now, just normal again. Right. And again, right now we're 1.13, 1.14%. We've technically analyzed not just silver and gold and their net trends and their momentum, but we analyze this spread. We do it on a daily basis and a monthly basis to see if we can define breakout points that say that this lull that you see in the spread here, where for the last handful of years it's been 1.5% or so. In the last couple of years, about 1.3%. To analyze when we think that could break out and surge again up to what? A normal of 2%. Okay. And that's a big deal because that's almost a doubling of the current valuation of silver to gold. And it's just getting back to a norm. So if you took gold to, $8,000, now why do I throw out that number? Well, we started from 1,050 back in 2015 at the bear low. Well, 8 folds over $8,000. And that would be simply saying, well, gold's going to do the same thing it did a couple times before. So we're not projecting 8,000. In fact, I've got some friends who are very thoughtful fundamentalists who think it can go in the 20,000s. Okay, forget that. But right now, we think that this spread is about to turn up. In fact, we've had a short-term indicator as of last week that said it is turning now. And we've got certain other levels not far above that tell us we're going to that 2% again. Well, that's a big move. And these spread moves don't occur with silver and gold going down. They occur when they're going up. Okay, silver simply outpaces. So right now, if somebody, asked me what's the best thing to do this year as far as investments, I would be long silver and I'd be long gold and silver miners relative to gold. Gold's the mama. It's going to lead the way up, but it's not going to lead in performance terms. These two subsets of the monetary metal sector will lead. I think it's the best place to be. And this chart merely reaffirms that, hey, it's no big deal to say we go to 2%. and silver went to 2%, it'd be $60. Okay, so obviously gold's not going to sit here if silver goes up, but let's say gold went to 5,000. You do the math. Although get 2% of the number. If gold had the normal eightfold move, and again in 1980 and in 2011, much of that came in the last year of the gold move. Okay, so if you do that, then $8,000. You do the math. What is it? It's $160, something like that. Okay. So the main point is that silver could vastly beat gold, and it looks like the technicals are ripe for that. It's certainly not going down versus gold. It's sat in a range since late 2022. In fact, frankly, at better levels than it was then. Yes. Various things. One, perception that the stock market is no longer a great risk-reward asset. It's now a risk asset. Okay. And once they become aware of that by getting kicked in the shins and then in the gut, as we're seeing, even today as we're speaking, we're getting clobbered again in the stock market. What this shows is simply since 2020. Remember back in the summer of 2020, we had a big upside move in gold, silver, and the miners. And in that time, gold shot up versus the stock market relatively. It got up to a 60% level, meaning the price of an ounce of gold was 60% of the price of the S&P. Okay. And then it pulled back. And since 2021, early 2022, it got down under 40%, like 37.5, and it shot up again and lived mainly around the 45% level, but in a range, technical clear range. Bumped the top of that range at about 47, 48%, about 4 times. It was like a ceiling. Well, last month marginally closed out above it. And this month, intra-month, you're well out above it, which is that last reading. So what it tells us is that technically, gold is shifting to an outperform mode versus the S&P. We thought that would occur simultaneous with the breakage in the stock market. So it's not merely a function of gold holding steady and moving up, but the stock market going down as well. Well, that, of course, catches the attention of asset managers if there's another place to be. And they've historically gone to T-bonds and gold, 2000 to 2002, 2007 to 2009. They moved into those assets. Right now, T-bonds are getting a rally, and I think it's largely because of the sense of danger in the stock market. But gold has been outperforming both widely, as you saw in that chart. It's not just the last few months, but last couple of years, it's well off that low. So that indicates there is a shift underlying, even though they're not beating the table about it. S&P dropped 50% between 2000 and 2002. NASDAQ 100 went down 82%. Okay, it had led on the upside, the leader on the downside. The same is true this time. Since 2009, the NASDAQ 100 went up about 18-fold to its highs a couple months ago. S&P went up about 9-fold. So you can double the performance of the S&P. The downside will be the same. However, don't take your eyes off of other sectors. I know everybody's focused just on, the big 7 thing, and the NVIDIA. Watch the banks, watch commercial real estate. When you create a stock market bubble of that duration and dimension, we've never had one like this in U.S. stock market history, of that many years up with that much dimension, caused, no doubt, by monetary policy. QEs ad infinitum, Fed funds rate at 0 for 10 of the 15 years, et cetera. No wonder you had a big bull. It creates errors. Creates stock market errors, it creates investment errors, it creates corporate spending errors, family spending errors. And when it breaks, when they rip the bandage off and take the needle out and you don't know no more hallucinogenic drugs, it goes to hell. And that will lead. But debt is a problem. Not just government debt, but okay. So you got to watch that sector as well. But generally, the leadership on the downside will be what had led the upside. That's the NASDAQ 100. On the price chart, now, by the way, that red line on the price chart is a 3/4 moving average. Mm-hmm. What we do is we average the prior three quarters of action and come up with an average, and that average applies for the next quarter. So it only shifts once a quarter. On the chart on the bottom, in their relationship to that average, you have a flat floor that's been hit 1, 2, 3, 4 times in the past year plus. Okay. You broke it last week. So we finally pulled that plug. And right now we're down below the zero line as well this week. So it's starting to really come apart. This is a long-term metric. And when it breaks, it means business. So as far as we're concerned, top is in place. The only issue now is not whether you're going to get a bear market, but the nature of the bear. Does it crash? Possible, unlikely. More likely, we're going to find next support of any consequence where you get a bounce that people might notice. Historically, 1987, the COVID crash, all 35% in a matter of a couple of weeks. Okay. Not 10, 12% slabs. So we could slab our way down seriously without crashing. And I think the next support is, like I said, while we're talking about 12% below where the market is right now. There's various reasons for that. But I don't necessarily foresee a crash event, but one definitely jolts asset managers further into some other place to be.